In today's lesson, I'm going to cover a number of different financial topics. And on the surface, they may not feel related, but they are interconnected. So we'll start going through them and we'll be able to tie them together as we move forward. The first is liquidity. Now, how liquidity has to do with how liquid an asset is. And the term, I won't get into the etymology, but it really has to do with liquidity means how quickly an asset can be converted to cash. So how quickly an asset can be converted to cash. Also not just how quickly, but how close to its original value is it going to be able to retain. So the second part of that is how close to the original value will the asset retain. So let me give you an example. If you had stocks in the value of $1 million, or if you had prize-winning horses that have run and won in the Kentucky Derby, and you have two horses and they're valued combined at $1 million. Both would create or represent the same value in your investment portfolio, but how quickly we can liquidate these, how quickly we can convert them to cash is going to be different. If you have stocks, you can convert the sale and convert it from a stock into cash in your account and then liquidate that, pull that cash out pretty quickly. If you have horses, prize-winning horses, you can't do that with several clicks. In fact, you're going to have to, number one, line up the right buyer, and then the buyer is going to have the financing, and then there'll be brokers involved and commissions, and of course, both will have tax implications, but this will obviously take longer to convert to cash. So the horses are not going to be as liquid as the stock is. If you had a savings account is holding cash for you so you can walk into the bank, withdraw the money, and you have instant access to it. But if you had an investment that you had to hold, if you had an investment such as a bond or a CD, a certificate of deposit, that had a maturity date on it, you're going to hold it for 6 months, for a year, or 3 and 5 years, then you have to wait for the maturity to expire before you're able to convert that asset into cash. Another example of an asset would be, let's say you have $1 million in real estate, in property. So if you have $1 million in real estate, again, a couple clicks, you're going to be able to convert your stocks from stock to cash pretty quickly. With real estate, you're going to have to involve the brokers, the attorneys, appraisals, closings, title companies. All of those individual parties are going to push this process out. And when it's said and done, the buyer may negotiate lower down on the price of the real estate. So it may have been $1 million worth, but when the deal was said and done, they may have negotiated down to $950,000 versus $1 million, or $900,000. And then on top of that, you're going to have the broker's commissions, 4% when you sell real estate, which you're not going to have a broker's commission on stocks that you're holding. So that 4% on $1 million is a pretty big chunk. So again, pulls down the amount of what the original value will be. If you had, let me give you a different example. 1 million in stocks, or 1 million in t-shirts. So you had an inventory of $1 million worth of t-shirts. Well, how long would it take you to sell all of your t-shirts? In that duration, not as liquid as your stocks. You could sell your stocks very, very quickly. The t-shirts might take you 30 days to sell all million of the shirts, or it might take you 6 months. And in that process, are you going to be able to convert to get $1 million back? You may have to pay commissions in between, or discounts and discounts as well, all affecting the overall value of the asset. So how quickly an asset can be converted to cash and how close to the original value the asset will retain. Now, converting to cash is important because of two primary reasons. Converting to cash allows the investor to, one, reinvest, or two, spend. So the plan in reinvesting can include liquidating, cashing out the asset before the asset drops in value, or reinvest for the purpose of, I actually want to cash out this asset because I believe it's close to its peak value. It's not going to grow much higher. And there's a different asset that I want to invest in, that I want to put my money into because I feel there's going to be growth there. And I need to move that shift. I need to move that money and make that shift before the markets change. So moving from an overvalued asset to an undervalued one is going to require great liquidity, so I have the ability to move fast. The other is, with great liquidity or strong liquidity, I can access my money if I need it to spend it. So if I had unexpected expenses, or just my lifestyle in general, if I wanted to vacation or make a major purchase, then I want to be able to make sure that some of my assets are liquid enough where I have access to them. If you had your entire net worth tied into assets that are hard to move, such as an antique. Well, if you had an antique painting, as an example, why would somebody buy an antique? Let's put this up here as an example. Why would someone get into an antique as an investment? Let's say it's a $2 million painting. Well, they're not making more of them, so they are rare. And if the painting is sought after, then it's going to appreciate in value. So it's going to go up in value. And that's what you're expecting. But to line up the buyer for that $2 million painting is going to take some time. In addition to that, you're going to have auction fees, right? If you sell it at auction, that's going to take you into that space. So if your entire portfolio or your net worth is tied into an asset that is not liquid, then you're susceptible to losing value and also losing on opportunities when you have a chance to get into a different investment. So that's liquidity. Now, when talking about liquidity, it moves me into opportunity costs. So the opportunity cost is when we trade money put into one item versus another, and ultimately what the potential was that you're capturing when you make the investment, or what you are not gaining because you chose not to invest and instead you spent that money. So Warren Buffett famously says that he would not get a $300,000 haircut. Now, I can't imagine someone on this planet that would spend $300,000 on a haircut unless you're going to get a return on it. And naturally, he wouldn't spend that much. But what he's talking about and what he's referring to is his ability to compound, to make his money grow through compound interest. And because he knows that he can take the $50 he would spend on a haircut and grow that at a 10% annual compound rate, or 12% or 21%, in time, while it wouldn't hit 300,000, it could get into the thousands of dollars. So instead of looking at his expense as just $50 today, he's looking at the expense as its future value. And he famously said that purchasing the single family home that he lives in today, when he bought that home, saying that that was one of the poorest decisions he made, because he could have taken that $30,000 that he spent on his home and made it into, ultimately, millions of dollars. Undoubtedly, he did that, and he's done that. But opportunity cost has to do with that. So imagine that you are an NBA player, you get drafted, it's your first year, you go in, and you get a $1 million contract. So you're pretty excited. So we're going to go back to 1 million. Let's get rid of this haircut. And you're a first-year NBA rookie. And you're going to... So you're an NBA rookie, and you get your $1 million contract, and you're going to spend that money on flying on a jet. You're going to spend that money on your entourage, which is keeping all the people around you happy. You're going to spend that money on your lifestyle. I mean, you're in the NBA, you got to look good. You spend that money on watches, on clothes, and parties. And you're not really worried about it. And you get this ridiculous apartment that's just gorgeous. And that apartment is like, I don't know, $40,000 a month, right? So in 1 year, it's $500,000. So at the end of the year, you're out of money. But you're in the NBA, you're making big dollars. You're looking and you're living like you're making those big dollars. At the end of the year, you're relying on getting a new contract because you are spending and burning through all of your money. The alternative is, if this NBA rookie were to take that $1 million and buy an apartment building, let's say that this rookie buys 2 apartment buildings, and the buildings were $500K each, and after they pay rent to him on an annual basis, these buildings are generating him $30,000 positive cash flow every year. So $30,000 of positive cash flow each building, and that's getting him $60,000 of cash flow between the two. Now, if this rookie ends up not playing the following year, or not getting picked up by a team, or whatever the case is, the opportunity cost is here, where the $1 million were spent on an incredible lifestyle. He looked like he was making real good money, and he looked like a baller. On this side, he didn't look fancy at all. He decided to invest his money into real estate, and they created positive cash flow. So his $1 million are getting him $60,000 a year in cash flow. Now, that's not a ton of money, but that is an annual salary that's coming after all the expenses on the buildings are being paid. So the opportunity cost here is either look like you're rich and not be rich at all, or invest in something that's going to generate a positive cash flow for you. And if he doesn't return to the NBA in time, these buildings will pay themselves off and the cash flow will get even greater. So he has a base of income even without having to work if he didn't return the NBA. So in this example, the same amount of money is spent, just it's invested on this side, it's spent on this side, and ultimately leaves the rookie with positive cash flow, and they're moving somewhere, versus maybe a lot of unhappy friends that don't have the ability to party with you anymore. So that is opportunity cost. And you want to look at whether or not you put money into a car, or you invest, if you invest in college, or you go on vacation. There is an opportunity cost always when you make a financial decision. Let's look at 401k. Now, a 401k is a retirement plan through your employer. So if you work for a company, for a business, you're putting money towards retirement from your check. So every time you get your paycheck, money is taking out and it's going towards your future self, your future you. So in a 401k, you can contribute, and there are limits. I believe it's like, I'm not going to give you the number because I won't get it right, but there are limits on how much you can contribute per year into your 401k. I believe it's $19,000 per year that you can put into your 401k. And I want you to think of this as getting taxed on the tree. So when you're putting money into the 401k, these are seeds, and you're not paying taxes on the money that you put into your 401k. So you're not paying taxes on the seed, but that seed will at some point grow into a tree. And once it grows into a tree, that's when you're retiring, when you get to the age of retirement, and you're going to be paying taxes not on the seeds, but on the tree. So think of your 401k as getting taxed on the tree. So $19,000 contribution. Number one, your employer can contribute into your 401k, and oftentimes they'll do what's called a match. So they'll say for every dollar you put in, they'll match $1 as well, up to a certain limit. Okay, so that's free money. You want to make sure that you are putting in as much. So if your employer says we will put in up to $600 every year into your 401k, as a very minimum, you want to put in the $600 on your own so that you get that match. And in the end of the year, that leaves you with $1,200. Now, if you leave your company and you have a 401k there, and you go to a different company or a different business, you can take your 401k with you. So that's called a rollover, in that you're not cashing out the 401k. You're not going to make it liquid. You're not going to liquidate your 401k. You're actually going to roll it over. If you say, I'm leaving and I'm going to another company, I want to take all the money out, I'm going to put it in my bank account for a while, and then I'm going to, if I go to the other company, a different employer, then I'll roll it in there. What you're doing and you're risking is creating what's called a taxable event. And you could end up having penalties if you don't roll over the same amount into your account. So without doing the withdrawal, the cash out, or any of that, when you started the new company will have a different 401k company, and you can just ask your old 401k company to transfer or roll over your retirement account to your new 401k company. And all that money that you've put in there and all the money that your employer matched, all that money goes over with you. There are events where you can do withdrawal. In events of a first-time home buyer, there's qualifications for that. If there's some type of catastrophic financial emergency, we've seen it with the coronavirus pandemic, where you can withdraw without penalty. But the idea is that this money is going to grow. You're putting the seeds in until it becomes a tree at your retirement age. And if you take money out before then, you're looking at a penalty. So you don't wait till 65 and you start pulling out money that's building up in your 401k, you're looking at a 10% penalty on what's coming out. So if you took out $100,000, you're not going to get the $100,000. You're only going to get $90,000 because $10,000 is going to go into the penalty. That's number one. Number two, if you took it out cash, you used it, and you didn't spend it back, and it wasn't an approved or qualified emergency cash out, then you're going to pay taxes at your regular tax rate. So if you're at a 27% tax rate and you took out $100,000, you're going to have $10K as the penalty. That leaves you with $90K. But because you took out the 100, you're also going to have a deduction of $27,000. That's actually 37 out, which leaves you with $63,000. So you took out $100,000, but you only had access and were able to utilize $63,000. That's a big, big penalty, and it gets really expensive. So it's not in your interest to take money out of your 401k before it's time to do that. Now let's look at an IRA. So an IRA is an independent retirement account. So some people are self-employed. They don't work for others. They don't work for a business or a company. And they also want to put money aside for their retirement in their future, for their future selves. You can do that through an IRA or through a Roth IRA. I want you to think of this as being taxed on the seed. So in the 401k example, you're not paying taxes when the money's going in. So it's a benefit that you can put bigger chunks of money in and it's going to compound and grow faster, which is really exciting. On the IRA or the Roth IRA, you're putting money that you've already paid taxes on. So you can't get taxed again when you withdraw your money. When it grows into a tree, you're not going to get taxed again. But you're paying taxes now, which means that you're not putting bigger chunks because taxes are cutting down the amount. So you're putting smaller amounts in. It takes longer for it to grow. But the upside is when you get to the tree stage, your withdrawal phase at retirement age, you're not paying taxes then. And so there's a balance. You can put money into a 401k, your pre-tax dollars, and you can put your post-tax dollars into an IRA. So that's the best way I can break it down for you. In the 401k, you're getting taxed on the tree. In the IRA, you're getting taxed on the seed. And the question is, where do you prefer to pay your taxes? Next, I'm going to go into capital gains. So we have capital gains and we have capital losses. So when your asset, when you sell an asset, you've got your purchase price minus your sale price equals, if that number is positive, you purchase something for $300,000, you sold it for $450,000 equals positive $150,000. You have what's called a capital gain. And then if that was the inverse, you bought it for $450 and you sold for $300,000, then you're going to have negative $150,000. That is a loss. So on one side you have a gain, on the other side you have a loss. And this is your asset. Beyond looking at whether or not you had a gain or a loss, you also have a short-term capital gain or long-term capital gain. Now, you don't have to hold an asset for a long time in order for it to be considered long-term. So, long-term, short-term. Long-term is longer than 12 months. And short-term, you guessed it, is less than 12 months. So if you bought Apple stock on April 1st of, let's say, 2019, and you sold it on April 2nd of 2020, then your gains, if you made money, are going to be long-term gains. Now, if you bought on April 2nd, 2019, and you sold on April 12th, 2019, you could have gained the same amount of value as in the previous example, but because you did it in less than a year, it's now a short-term gain. Now, why does it matter if it's a long-term gain or a short-term gain? Long-term capital gains are taxed at a much lower rate, much closer, depending on the asset, to 10%. If it's short-term gain, it'll be 10 or 15. for long-term capital gains, assets held longer than 12 months, longer than 1 year. If it's a short-term gain, then you're going to pay at your income tax level. So if you're paying at a tax rate of 27%, the exact same gain is going to tax a lot heavier versus if it was long-term. So if you made, let's say, $100,000 by holding longer than a year, you would pay 10% in taxes. You're taking home $90,000. But if you made $100,000 on your investment with Apple and you did that in less than 1 year, your $100,000 taxed at your tax bracket, 27%. Let's say that's federal. That doesn't include your state tax. You're going to end up bringing home, before state taxes, you're looking at $73,000. Okay? So a big difference in the taxes. Now, the same way that you have capital gains, you can have capital losses. So if in this year you lost money on your assets, through your assets, and you lost, let's say, $5,000 or $10,000, that was last year, you lost $10,000, and this year you made $15,000. Well, then you can take your losses from 2019, your capital losses from 2019, negative $15,000, and your gains from 2020 of positive $10,000, and you can use your losses to offset your earnings from this year. So you can carry over. There might, I believe there's a cap. So your carryover might be capped at $3,000. But if it's greater than, at least on your $10,000, you're going to carry over negative $3K. So it's going to take your capital gains from positive 10 to positive $7,000. And that means that you're going to pay 10% on $7,000 versus 10% on $10,000 in capital gains. So that's how capital gains, capital losses work. Now let's look at net worth. Net worth is easy. We've covered this before. If you want to measure your net worth, you're going to take your assets, the value of your assets, and you're going to subtract. If you want to figure out your net worth, you're going to take your assets, the value of your assets, you're going to subtract your liabilities, and that equals your net worth. So if your assets are, let's say you've got those 2 horses that are $1 million, and you've got 2 buildings that are another $2 million, another $1 million. So combined, you've got $2 million in assets. But then you have loans out on the buildings, and the horses are paid in full. But on the buildings, you owe $800,000. So we're going to take $2 million minus $800,000, and that leaves us with $1.2 million. This is your net worth. Let's look at the SEC. So the SEC is the Securities and Exchange Commission. Now these guys sound pretty official, and they sound like the real deal. They are. They're not a government agency, but they are in charge of regulating basically the stock exchanges. So they are the oversight, and they make sure that companies that are being traded on the stock exchange and the buying and selling of stocks on the stock exchange happen in a fair way. So they're constantly looking and overseeing all the buying and selling of the assets inside the exchanges, and they're monitoring how these publicly traded companies are operating. So the SEC have a very serious role when it comes to investing. If you have questions, be sure to post in the notes, and I will be able to get back to you. That's what I have for you on the Security and Exchange Commission.